bank risk management officers as well as by regulators. And so that when financial innovation can be a good thing, it brings benefits economically to economies, but it also introduces risk, often new risk that have to be assessed and controlled. And so regulation has to be vigilant. It has to be looking not just at the past, at what caused the last crisis, but looking at the future, looking at how markets may be evolving and changing in the future. Part of that involves recognition of interconnectedness of markets and systemic risk. Traditionally, before the crisis, we thought that banks were really the main source of systemic risk. And so there was a very comprehensive prudential bank regulatory framework in place for banks and what they did on their balance sheet. But banks could engage in risk transfer and shift risk off their balance sheet to non-bank entities and non-bank firms that were not subject to an equally rigorous prudential regulatory framework. And that's where some of the problems arose in the recent crisis. And so there's a focus now on interconnectedness in markets and in how risk can evolve in the non-banking sector. Non-bank financial intermediation is a very important focus that regulators are beginning to address, but not fully yet because it's not well understood. This is also called shadow banking. And then, of course, there's the problem in the recent crisis that large banks do pose too big to fail risk, and especially when they are so big where they can't be resolved efficiently or readily, and therefore they have to be bailed out by taxpayers as a result. And so another big focus of regulation has been on trying to create adequate resolution frameworks so banks can be more easily resolved when they experience severe financial distress. So now we have the UK, for instance, adopted its first bank resolution regime in 2009, and then the Bank Resolution Recovery Directive has been adopted in 2013 by the European Union. And so the focus is not just on the front end of bank risk-taking, encouraging more effective risk management, it's also focusing on the back end, the ex-post side, where if banks fail, how do we resolve them and do it in a way so that we can control the negative fallout or the negative externality of the broader financial system. Capital Markets Union, comes along. It's sort of now the big topic. We've come through all these prudential regulatory reforms in Europe, and now we have CMU. And the big focus on CMU is to try to enhance more capital and more financing from non-bank financial intermediaries and trying to enhance the flow of investment to companies, but also the flow of investment from asset management companies, trying to make the regulatory framework free it up in the European Union to achieve internal market principles of the free flow of capital, free flow of services. Capital markets need to play a larger role in channeling financing to the economy. So it's a big focus on capital markets. And we heard this morning Professor Maloney's presentation, Professor Ring's presentation, what the objectives are, what are some of the basic elements of the CMU. We had a very interesting discussion last hour before lunch on securitization as one of the specific sources of risk, and then looking at some of the broader issues of varieties of capitalism and corporate governance. And all these issues are implicated in the CMU framework, because it's very broad. It applies to everything really that's outside of the formal banking sector as far as the bank intermediation role is concerned. Now, some of it, of course, applies to banks in their capital market functions. Many banks, of course, advise on in merchant banking type activities and capital raising in financial markets. And so the banks are very much interested, of course, in how this new initiative will evolve. But I think that in looking at the green paper and looking at some of the commentary that's been written about it, one will notice that a driving objective behind this Capital Markets Union initiative is the fact that Europe has basically had very low economic growth over the last few years post-crisis. And there's been a comparison made to the United States, saying that after the crisis in the US, growth has now begun to go up. And we're getting higher real GDP growth in the United States compared to the European Union as a whole, especially in the Eurozone, where we've got almost no growth, a little bit above zero right now. And so there is a view, or I would say an assumption in Brussels, in the Commission, that we need to have an internal market or a more harmonized framework for capital markets because the US has it, and because by having this more harmonized framework for capital markets, Europe should move away from bank-led finance, or in other words, away from the universal banking model to a model that has a better balance between bank finance and capital market finance. And so the U.S. is sort of used as a model. Now, I'm going to suggest that this is not an appropriate policy, that this is, there are a number of reasons why, but I think that this is should not be one of the driving policy objectives for the CMU. One of course, in Europe, in continental Europe, excluding the UK, bank finance is 70% of finance that companies get. There's a 70-30 ratio split, 30% being from the capital markets. In the US, it's almost the opposite. 30% of the funding that companies get come from banks, and 70% roughly come from capital markets, where companies go directly to investors in the market, either on exchanges or even more informally by just issuing debt instruments and commercial paper in the off-exchange markets. And so so there's a big focus on shifting that ratio. That's behind one of the objectives behind the Commission proposal. And to do that, there is a concern, rightly raised in the Green Paper, that there needs to be more standardization of European capital markets, that you need to have more standardized requirements for how companies raise capital across Europe. There needs to be more standardization of the risk assessments that are done, so investors can compare the riskiness between different issuers of securities across jurisdictions. So there's a big focus in the Green Paper on standardization. However, I'd like to point out that, and there's a big focus, as you know, on small and medium enterprise funding, trying to enable SMEs to go to the market and raise more money. And not to rely so much for their funding on banks. And the concern there is understandable. Right now in the Eurozone, many of the banks have got high levels of impaired loan ratios. I mean, they've come through a severe recession, there's been a crash. The banks have had huge losses because of the banking crisis a few years between 2008 and 2009, and now the banks are not able to generate the funding for the economy that they were doing before the crisis. And so there's an understanding, it's understandable that the Commission, the policymakers would want to say, we need to look at alternative sources of finance other than the banking sector. The banking sector is very feeble right now. And so that's an understanding policy objective. But one should also realize, though, that there are some benefits to bank-led finance systems. In the bank-led finance system, of course, banks and the universal banking model have greater scope and scale for diversification. So they're able to often provide more products to their customers because they themselves are able to engage in a wider array of financial business activity, and so there are all the benefits of the universal banking model that should not be forgotten, and that once the EU, the banks in continental Europe can come through this recent crisis, they would probably be able to start playing that role again of providing more adequate finance for the economy. Also, it should be understood too that small and medium enterprises are heterogeneous across Europe and across different capital markets. And to standardize their capital raising would be a real challenge. It would raise more question marks and create more risk for the firms if they tried to standardize their risk in a cross-border capital market. And banks, because they invest in information, they invest in relationship banking, banks obtain specific knowledge. And bank intermediation for many economies in Europe and for small and medium-sized firms in particular is often more efficient than having the same firms go directly to investors in the capital markets. And so I think so one of the concerns I have about the green paper is that small and medium-sized enterprises will be better off if they're able to strike a better balance between capital market finance and bank-like finance. Often, for most small and medium-sized firms, because of the heterogeneous nature of their business, the unique market that they may be operating in, it's better for them to they can get more cost-effective funding from a bank that is one of their traditional lenders that understands their business model better than they can by going to the general capital markets. There's another concern I have with the green paper in that I don't think there's been really an emphasis on the financial stability implications of some of the proposals. The big focus on securitization, the big focus on structured finance and in the wholesale capital markets. Although there should be more funding coming from wholesale capital markets, at some point in the future, we know, as the European economy will recover, we'll have more securitization will return to the market. But in the meantime, regulators should be carefully monitoring how securitization is brought back to the market, because there needs to be a focus on the adequate pricing of risk. And as we heard from Dr. Barboso in the lecture last hour, there was an underpricing of risk in the securitization markets before the crisis, which led to too much complexity, too much tranching of assets, and created the types of risks that later brought the financial system down. And so we know that the mispricing of risk can lead to excess credit supply, and then it can even lead to a bubble in the market. And so these issues have not been given adequate concern, I think, in the green paper. Now let's turn to Europe and the banking union. But before I go to the banking union, let me just, as I said earlier, the focus in Europe has now been on macro-prudential regulation. And the Larosière report issued in February 2009 proposed the new framework that we now have, and the creation of a European Systemic Risk Board to monitor macro-prudential risk, and the creation of the European System of Financial Supervision, which is a collection of 3 European supervisory authorities who will supervise the national competent authorities, the banks, the securities regulators, and the insurance supervisors. And so we've got the 3 new ESAs, IOPA, EBA, ISMA. And now what's important about this is, many of you know this, and this has now been the law since 2010, but the focus here is that regulations should be more holistic. It should be more macro-prudential. We should not just be focusing on individual firms, individual investors, but the focus of regulation should be across the whole financial system. And now this is very difficult, of course, to legally define. What do we mean by macro-prudential regulation? And we can have a whole seminar on this. But the background to what is being faced in the Capital Markets Union is the fact that we have a current framework for the whole EU that is focused on macro-prudential regulation and monitoring macro-prudential risks that can arise easily in the securities markets, especially in the structured finance markets, as well as with the banking sector. Let me turn to the SSM, the Single Supervisory Mechanism. This is the banking union framework. The banking union basically consists of 3 pillars: banking supervision, resolution, and deposit insurance. And so 2 of those pillars are actually operating now, the SSM, the supervisory pillar, and the resolution pillar, the SRM. And I have this chart here. It's a bit complicated at first glance, but basically the green boxes, the green shaded areas are the areas where the bank supervisor has got primary competence. So for large systemically important banks, that would be the ECB for the significant credit institutions. Now, I use the word credit institution because under EU law, a credit institution is an institution that takes retail deposits, not wholesale deposits, but retail deposits, and then it makes loans. And bank lending, normally mortgage loans, small and medium-sized business loans. But the key defining attribute is that it takes retail deposits. So really the competence of the ECB is to regulate credit institutions defined as such under EU law, which narrows the scope of financial institutions that it can directly supervise. Because there are financial institutions that don't take retail credit deposits, but have short-term liabilities that could be systemically important, which could be systemically risky. And so, but the ECB is focused on directly on these large institutions, about 130 of them in the Euro area. And then it oversees the NCAs, the national competent authorities, in the supervision of the rest of the credit institutions, the medium-sized and smaller ones across the rest of the Euro area. And so it is responsible. So these are now the national competent authorities here take direct supervision of these not significant credit institutions, and so that's the general framework. Now, within that, there's a lot of, that they implement the technical standards and the regulatory implementing standards that the European Banking Authority adopts in London, and then the ECB writes their own rule book as well. So there's a lot of, technical controversy about the scope of ECB power here. But generally, their competence is for the credit institutions. What they don't have competence for are financial institutions that have short-term liabilities, but they don't have retail deposits, and that make loans that are the shadow banks or non-bank financial intermediaries. And so anyone involved in financial intermediation, whether it's a maturity transformation type process or if it's even shorter term, where the liabilities are short term and the assets are short term, they fall into this yellow boxes, and this is purely up to the discretion of the national competent authority to regulate. And so we have the NCAs here. Now, it could be, in some countries, it could be the bank supervisor who's got jurisdiction over the so-called shadow banks, or it could be a securities regulator, depending on how that institution is classified in the member state. And so there's a variety of approaches to regulating the shadow banking sector. Here is where the risk in the Capital Markets Union will be: how do we regulate these institutions that will be freed up, supposedly in theory under the Green Paper, to provide more finance, especially the wholesale financial intermediaries that will be involved in structured finance and some of the riskier side of capital market transactions. They are not subjected to the strict prudential requirements of either the Capital Requirements Directive or the ECB supervision. Now, I'm going to just skate through this, but this is the SRM, the second pillar of the Eurozone, of the Banking Union. And the Banking Union basically created a second pillar, but the second pillar does not have the centralization of power that the ECB has for the banking supervisory powers. The resolution framework is built on the shoulders of the national resolution authorities, but they have to send representatives to a single resolution board, which adopt principles and standards and rules of how the resolution law will be implemented in these jurisdictions, and the single resolution board can make recommendations and proposals that banks in these jurisdictions be taken into resolution. And so the SRB board is very important. And so, but the interesting point here is that the requirement for the resolution framework is that banks and a number of investment institutions that are not banks, that are not credit institutions, like with the ECB, a broader scope of application of the resolution framework to non-bank financial firms is applicable here. So under the SSM, it only applies to credit institutions. Under the SRM, it applies to credit institutions, plus a broad array of other investment service firms that are also subjected to the Capital Requirements Directive. And so which could be many of the capital market players that are going to be affected by the Capital Markets Union proposal. Finally, I want to make some observation about what I call a functional perspective on finance. I think that as first, what we have in the green paper is really a push to try to get the European capital markets to emulate more the U.S. capital markets, on the assumption that the U.S. has got higher growth. If Europe can have a more similar capital market structure to the U.S., they'll have higher growth, and they'll be more sustainable. I think that's a flawed assumption, first of all, for a number of reasons. I think institutionally, Europe's economy has developed differently. There are different notions of corporate governance and financial structure in different European economies. And so that first assumption in the green paper, I think, is flawed. The second point I would suggest, if I were to be involved in drafting a policy paper like this, I would say that we should only have policy intervention when there are externalities or other market imperfections. You should, first of all, identify sources of market failure first before you draft a big green paper saying that we're going to redesign the whole market and try to achieve higher levels of growth. What are the market imperfections? What are the market failures that we have now? Market failures are not just banks failing. It could be oligopolies. Pagoo, the Cambridge economist, wrote about one of the biggest sources of market failure was oligopolies and monopolies. That required market intervention to restore competition. So first of all, in re-regulating any market, you need to first of all start with basic principles by identifying what the market failures are. Policy, and then after those market failures are identified, policy should be neutral in terms of how the policy is applied. And that's so institutions that do similar things should be regulated in similar ways. We should not have, for instance, in Europe, some non-bank banks not subjected to capital requirements because they're not a credit institution under EU law. So I'm basically taking more of a functional approach to regulation here. And then, and regulation should, as I said, that should address information asymmetries, agency problems that affect monitoring, screening, and moral hazard. These are the kind of traditional weaknesses that financial markets have been afflicted with in the past. We see in the green paper, though, a big focus on regulations that would favor non-bank financial intermediation, and that there tends to be a push, a policy-driven push, to redirect the provision of finance over to capital markets, away from bank-led financial markets. And so I say, okay, well, fine. If you're going to do that, show us the market failure. What is the need for the regulation? I don't think that's been adequately demonstrated in the green paper. And so that's basically it. One last thing on macroprudential. I've got a summary of the new UK framework, of course, as I mentioned earlier. I talked about macroprudential regulations is the name of the game. And the UK has adopted the judgment-led supervision approach that Chancellor George Osborne announced with the Financial Service Banking Act of 2013. And a very good summary of judgment-led supervision is by none other, he's now Lord King of Lothbury, but as he then was Sir Mervyn King, stated that the culture of regulation needs to get away from this game in which the regulator writes ever more complex regulations and the banks and their lawyers write new products, which are essentially the same as the previous ones, but are defined in such a way as not to be caught by the latest rule and regulation. This leads to a very expensive and unnecessarily complex system. The focus should be on future assessments of risk, what they call judgment-led supervision. So this approach is the mantra of the new UK framework. Now, whether it's being implemented in that way is another question, but I would suggest that in adopting any reform of capital markets law in Europe, we should also take into account the focus of regulation, which is to address externalities and to address systemic risk. And that judgment-led supervision should be a principle that should be embedded into any regulatory framework that is to oversee capital markets. So with that, I will end, and thank you very much for listening.